A leading payment services fintech provider is selling at a 40% discount. It's not PayPal, down 66% over the last year, and it's not Block, down 76%. In fact, you can't buy shares of this company in the stock market. The company is Stripe, a pre-IPO fintech commanding a fifth of the growing payments market, nearly as much as Square, Amazon Pay, and Adyen combined. The only way to invest in Stripe is through a private equity platform, but the good news, it's trading at a 40% discount to the most recent funding in the private market. Open until October 31st. You can invest in Stripe for $40 a share on the Disruptor app. That's a valuation of $55 billion for this payments company, 40% below the valuation in the previous funding round in just March of last year. All you out there in the Bowtie Nation know this world of that pre-IPO venture capital investing is where I got my start as an analyst. The returns are like nothing you see in stocks, and now is the best time to start investing, but you need to know how to analyze these deals. So that's what I want to do today. Take a deep dive into the analysis for Stripe, show you how to analyze one of these pre-IPO deals, and 2 reasons why now is the perfect time to invest. Now, before we begin, I do want you to understand, right now only accredited investors are able to invest on Disruptor. It sucks, and I hope it changes eventually, but because of rules by the Securities and Exchange Commission, the SEC here, only those with $1 million net worth or a certain level of income can invest in these pre-IPO companies. There are a few other platforms available to everyone, and I'll link to that video in the description below, but watch through the video anyway, so you can be ready to analyze these deals no matter where you find them. I wanted to cover this though, because in all my years working as a venture capital analyst, I never saw a better time to invest in these types of companies than right now. First is because we're about to see a shakeout of the weaker players in the industries that are going to leave the survivors much stronger. A report by Deloitte found more than 2,400 fintech payment services companies just last year, more than double the companies in their 2009 estimate. And that competition has lowered the profitability for everyone. Now, with the potential for a recession worldwide, some of those companies are not going to survive over the next year, but Stripe has the scale and the funding to not only survive, but to take some of that market share and grow with it. Better still though, valuations across not just payment services, but all these pre-IPO companies is way down. Shares of PayPal and Block are down to less than a third of their peaks, and the valuation for Stripe itself is down by 40%. It's blood in the streets for fintech, and that is the time to buy. Now, I want to get into that analysis for Stripe to show you what to look for in these deals. The investment is available on the Disruptor app, a private equity investing app that makes pre-IPO investing affordable and easy, investing as little as $1,000 in each company. You can invest in private tech companies just as easily as buying a share of stock. Previous investments available on the app include Airbnb with a 105% return, Palantir for 133%, and Lemonade, which saw a 172% exit for the investors before the IPO. Despite that big drop in the payment stocks this year, the global digital payments industry is still booming. A March report by Deloitte estimates the transaction volumes will reach $11.3 trillion by 2026, or about 13% annual growth from last year. And revenue to service providers is going to grow by 24% a year. All you out there in the nation know that's exactly where I love to start my research for investing. Finding those big growth industries that are going to lift all the companies within that space. You start with that top-down approach, finding the high-growth industries so that any investment in that space is going to do well, but then drilling down to the best-of-breed companies for even higher returns. And here, that's where we see Stripe. We'll go through the complete analysis next, but this chart really got my attention. Stripe has a commanding share in its industry, second only to PayPal. It's also signed multiple strategic partnerships lately, including a 5-year deal with Ford and with Spotify that is going to help it maintain and grow that share dominance. Now, because of the market sell-off, valuations across fintech are being slashed, and I'm going to detail that later, but Stripe is raising money now at $40 per share for a valuation of $55 billion. Stripe allows companies of all sizes to accept digital payments, pay bills, and track their business. Now, that's nothing new, but what is new is the ease of use for developers of this platform. Stripe has made it easier than any other payment platform for developers to create integrations and functions unique to any business. That has allowed Stripe to grow to over 2 million customers and 3 million website users, with 90% of the bank cards processed through its network. Now, what's exciting about this is you've got a combination of that strong industry growth plus Stripe's competitive advantage to grow even faster. Market Research Future estimates the payment gateway market alone could reach $193 billion by 2030. It's about a 10% annual growth rate. Beyond that, an increase in online transactions, digitalization, and automation makes this one of the best growth industries out there. Stripe is the second most used platform in this industry with a 20% market share, second only to PayPal, and this is one of the biggest points I always look for. And besides finding that growth industry, you also want to invest in the leaders within it. Now, why fight that market dynamic, right? The market leaders have that dominance for a reason because they've perfected some kind of an advantage. And what happens so often is the market leaders are able to use that advantage to grow and then dominate their part of the market. And then they use that to grow at a scale that allows them to cost advantages for even stronger share. And right now, as we move into that economic recession, businesses are going to need every advantage they can get, and the strongest will be the ones that survive and grow market share. Besides those deals with Ford and Spotify, Stripe signed a partnership with Twitter to pilot its crypto payments and its product integrations with millions of customers. Stripe has raised funding in 8 rounds for a total of $2.3 billion from some pretty legit Silicon Valley investors like Elon Musk, Palantir co-founder Peter Thiel, and Google Ventures. Even after the recent valuation cut by Fidelity, it's still a $55 billion company, and I would expect very close to an IPO exit once the market recovers. Now remember, this is how private companies and those startups grow before an IPO on the stock market. They hold funding rounds for private investors that get a big cash out when the company issues shares or is bought out by another company. If the stock market hadn't crashed this year and IPOs were still fetching strong interest, it could have been this year, but now it's likely later next year or maybe 2024 before we see that kind of similar environment. Revenue here is from fees on payment transactions, usually 2.9% plus 30 cents per transaction, or 3.9% for international transfers. Payment volume has increased at a 200% annual pace since 2016, slowing to 82% growth and $640 billion last year, but still at a pace any company would kill for. Now that's ballooned revenue to $12 billion from just $450 million in 2016. Now I want to show you how to value these private companies, something you don't see much here on YouTube, but that's the bread and butter of a venture capital analyst job. This is what I did for years, turning these numbers into a valuation analysis using acquisition data and then those public companies to find a good investment. So you see here on Disruptor, we have some comparisons with publicly traded stocks in the industry. You've got Adyen, PayPal, Block, and Fiserv. We also have the enterprise value, which is just the market value minus cash, but then adding back debt. That's the total market value of a company, including what's on their balance sheet. We also see the annual revenue and the revenue growth for each company. And PayPal is by far the largest in terms of annual revenue, but Block, Fiserv, and Stripe are pretty close second. When you look at the growth, though, Stripe is still growing its revenue by 30% a year versus 10% or lower for those other 3 dominant players. And what's interesting to me here is how Stripe has managed to keep that revenue growth so high, even at that scale of Block and Fiserv. I think it points to a real competitive advantage and that the company is taking market share. Now with this, we can get an enterprise value to sales number, and that enterprise to sales ratio, or EV to sales, that is key here because it's the main metric we use in private equity to value a company, whether for an investment or to make an acquisition offer. Dividing that enterprise value by the sales amount gives us a relative value that we can compare across companies to see which is less expensive and which are better deals. So then taking Stripe's estimated $55 billion valuation and then dividing that by the $15.6 billion in estimate for this year's revenue, that's given us an EV to sales of 3.5 times. Here we see that compared to these other public companies, and even though Stripe is expected to grow much faster than almost any of them, its valuation is much lower. In fact, if Stripe was valued even at that multiple Fiserv gets in the market, it would be worth $82 billion instead of $55. Now that's a comparison with public companies. There's another way we can value private companies, and that's through acquisition deals. What values are being offered for other companies, and what does that tell us about our target company? And because the industry is growing so quickly, acquisitions were hot over the last few years. Deal activity jumped 50% in 2021 to $60 billion from the year before. And Square made a monster buy of $29 billion for Afterpay at a valuation of 42 times on an enterprise-to-sales basis. PayPal bought Paydi for $2.7 billion, and PayU acquired Indian payment gateway BillDesk for $4.7 billion. Now, Square's valuation of Afterpay shocked the market, but even across these other deals, targets were getting about 15 times on that enterprise-to-sales basis, according to a report by Bain & Company. Now, honestly, it would be hard for a company to get that 15 times valuation in today's market, but even at a 10 times valuation, it would put Stripe at $156 billion, nearly 3 times the valuation on shares are being offered right now at a price of $40 each. Of course, as we say here on the channel, it's not all rainbows and unicorns, and I want you to pay attention to the risks here mentioned on the app, as well as just understanding the market environment for private equity companies right now. That industry growth and the opportunities attracts a lot of competition, and some of these are heavyweights I wouldn't want to mess with. Companies like PayPal, Amazon, and Square have the size to pack a punch like Mike Tyson, and Stripe has to watch out that it doesn't become Evander Holyfield's ear. It's also a changing regulatory environment as governments figure out exactly how they want to control digital payments, so there's always that risk of change. With that strong market share, I don't think it's competition that's really the problem here, but just the poor market environment for all fintech companies. And stock performance for fintech IPOs has plunged since last year, and stocks newly issuing shares have fallen 60% on average according to payments.com. That's the orange line here compared to the NASDAQ in blue. So naturally, that's weighed on the acquisitions and all the deal activity in the space, with $150 billion in planned deals being postponed or canceled. That kind of market just means investors are going to need the patience to see a return, probably waiting at least a couple of years for the company to issue shares in an IPO or accept any kind of an acquisition offer. For investors with the patience to wait a few years, though, it could be a solid return on an IPO. Even if Stripe revenue growth slows to 20% over the next 3 years, which is well below what it's doing already, that gets it to $27 billion in annual sales. By then, the market will have surely recovered, and the environment for IPOs will be back. So if shares IPO at a valuation of even 5 times sales, which again would be extremely conservative, you're looking at a $135 billion company and a 145% return on the current deal. I would expect an IPO for a growth stock like this to fetch closer to 10 times price to sales, but even on a conservative estimate, that's still about 35% a year return. Check out the Disruptor app with the link below and the Stripe deal open until October 31st, or click on the video to the right for a step-by-step to investing in pre-IPO companies like these. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.